Hello everybody, Stuart Heath here, CEO and founder of Harvard Grace Capital. With this week's nerdy numbers, we follow data because that's what we do. We track the markets that we're in, and then we want to report back to you data that we find interesting that's impacting about how we see the investing market. So appreciate you taking the time and watching here. So there's an article just popped up into my feed from Yahoo Finance, and it says, here's the title: more than half of U.S. homes lost value in the past year. Well, that's going to get my attention, and it's going to get the attention of a whole bunch of other people because it's true what they say that most people's home is the biggest investment they will ever have. Well, that's not the case for me, but it's still a pretty important thing. And more importantly to us is that we understand that housing is not just the basis for the entire real estate economy. It's the basis for the entire U.S. economy, if not the world. People buying homes drives economies. Sorry to break it to all the people out in Silicon Valley and all the tech, and I'm not taking anything away from what you do. What you guys do drives economy. Tech spending drives innovation, and it drives business spending and all the fun tools that we like to have at home. But the point is home. We are a real estate-based economy. We always have been. And until we become ethereal bodies floating around in space and don't have to have places to eat, sleep, and drink, we're going to stay a real estate economy as long as we are physical beings. I think that's just a fact. So anyway, this headline got our attention. More than half the homes. So for starters, this study is from Zillow. And Zillow's a great company. I use their services. Their AI-based zestimate tool has gotten better over the many years that I've used it. However, it's still an estimate. And the one thing you got to know about the zestimate tool is it needs lots and lots and lots of data points. So when we're in an economy that's actually slowing down, it comes up with conclusions like, oh, well, houses are actually declining in value. That is not the case. And then the article even further goes on and says that most of the declines are happening in the Southeastern United States. Well, if you look at this little map here showing you the metros where the greatest share of homes that have lost value, there's not a single metro in there that's not in the state of Florida, that's in the Southeast. And Florida is its own market, and each one of those cities are their own markets. And the Southeast, we know, just like Texas and Florida, have been huge beneficiaries of the great migration that's happened from the Northeast, the North's Midwest, and the West Coast. A lot of folks have come, and new bodies means new homes. So what is happening here? So we have an inventory problem. In our view, this is a short-term problem. Inventory has been built, and because of this, we also have an inventory of existing homes, and sellers not willing to take. So they probably got their 2.5% or 3% mortgage. They're willing to stay, but they'd like to move on if they can, when they get the price that they want. So this is completely, in my view, 100% related to interest rates that are too high. And you can get a mortgage today in the mid-6s, and it's been coming down, but we haven't really reached that rate which is just going to jumpstart the economy. I think we got another half or full point to go before that's going to happen. So anyway, take a look at this. Would love to hear from you, and let's have a conversation about what you think's driving this the slow housing market. Thanks a lot.